Hey everyone, today on the final bar, we will wrap the week, our normal Friday routine, looking Friday to Friday, how the markets have evolved. This has been an eventful week by any definition of the sort. So we're going to look at what the charts can tell us. And at times like this, when there's plenty of uncertainty, headwinds, tailwinds, questions about what the where things are headed, always pay attention to the message of the markets manifested through the charts. The S&P going higher. What does this mean for next week and beyond? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the charts, try to understand how things are moving, what's working, what isn't working, try to increase our situational awareness, our market awareness, if you will, to understand all the different pieces that make up the financial markets. As always, as I mentioned in the introduction, this is certainly an uncertain time. There's so many things up in the air, I feel like, with geopolitically, economically, with healthcare and so forth. So, more than ever, I think you're doing yourself well. You're doing your portfolio and your clients and whoever you are investing for a service by focusing on the charts. And if we can help you do that, I'm pretty happy about that. We had some great guests on the show this week, really helping us break down some of the key charts in their own arsenal. Next week will be more of the same. We have three great guests lined up for you. On Tuesday, the 12th, John Kosar. It's one of my favorite macro analysts, really breaks down using what he calls the Asbury Six to identify strength and weakness with price, breadth, and sentiment. On Wednesday, the 13th, we have Doug Bush from Chart Smarter in New York. He's a fantastic stock picker, always brings some good tickers along with him. And then on Thursday, we have Julius DeKempener, founder of RRG Research and an expert in sector rotation. So by the end of next week, hopefully, we will have covered all those pieces of the equity puzzle. That should set us up beautifully for Saturday's special. On Saturday, the 16th, we will release our 2021 market outlook called Charting Forward 2021. We have a fantastic group of experts that we are assembling now, doing some interviews this week and next week to capture their big picture perspective on where they see things headed over the course of the year in terms of the S&P, in terms of precious metals, U.S. versus non-U.S. stocks, small, mid, large, best sectors, underperforming sectors. We're going to try to uncover all the themes that they're paying attention to and help us, derive some insights from there. So Grayson Rose and myself from StockCharts will be moderating that discussion and introducing some of the topics. I think you're really going to be excited from the content you'll be able to get in a short amount of time from some really knowledgeable market strategists. Let's get to our Wrap the Week segment. I wanted to start with a survey that we asked all of you. We have polls running pretty consistently on our StockCharts TV page, which is stockcharts.com/TV. Also on our YouTube channel. If you're a subscriber, you'll get our polls right through YouTube and also on our Twitter channel. So make sure you're checking us out anywhere that you are and answer the polls when you can. We asked you recently, which asset class performs the best through the end of March 2021? So a first quarter outlook, what's doing the best? And interesting to ask these questions because I'm always fascinated by what's happening in the short term and how that might impact everyone's long-term discussions. I bet if we ask this question in December versus today or the last couple of days, our answers might have been different because we certainly saw some upside resolution to stocks and S&P getting the number one amount of votes of almost 60% of you. 32% said gold, only 5% said bonds, 4% said the dollar. So as a contrarian, I'm immediately drawn to the charts of the bond prices and of the US dollar and thinking, does that mean they've gone down enough if no one pretty much thinks that they're going to do better than these other assets in March? Through March, does that mean that we are overextended and ready for some sort of pullback where everyone will be caught on the wrong side of things? But it's hard to, if I would answer this, I would probably say gold, and I know that's probably an unpopular answer now, given gold and gold stocks breaking down, stocks and sort of offense, consumer and so forth breaking higher. But I do think we're going to have plenty of uncertainty that comes over the next couple of months. And I think it could be a crapshoot between the two of those, to be honest. Great, great poll responses, and thank you all very much, as always, for keeping keeping an eye on that. As much as you can answer and share your thoughts with us, we appreciate it. Let's get on and continue our wrap the week adventure here. I wanted to start with a weekly review of where things have played out. I don't have some great labels on here right now, so let me just walk you through what we're seeing. This is starting at the end of last year, so starting basically at the end of last week's trading. Look at the last 5 trading days and looking at the performance from the starting point to where we're at. The number one performer, as you could probably guess by the fact that it is light years ahead of everything else, is indeed Bitcoin, which is up 35% just year to date. That shows you the movements that we've had there. And if you missed it, Bitcoin has accelerated to the upside, breaking above 40,000, which is not long after it broke above 30,000 and a couple months after it broke above 20,000 for the first time. So, all of this has happened very quickly. This is a new era of sorts, I think, in terms of cryptocurrencies and, sort of adding a zero to a lot of people's interpretation of it. The question now with something like Bitcoin is, how far is far enough where people start to question the viability of prices being at that level. And that's the nature of any sort of bubble scenario. When something goes up an order of magnitude, a couple of magnitude, you have to question, at what point do things sort of right size and you recalibrate. And if you think about what Bitcoin did up until 20,000, it then took quite a while for it to get above it for good. And maybe we're nearing 40, 50,000 is where a similar sort of recalibration may take place. I'm not sure. What I do know is that the trend has been positive and remains positive until proven otherwise, up 35% just in the last week. After that, we sort of have the S&P 500 here, just up about 2% for the week as we lock in the closing prices. So what else outperformed stocks here in brown? We have crude oil, which is up 7.3%. So clearly one of the better performing assets. Small caps not far behind, up 6%. This is emerging markets. Up 6%. So, the similar characteristics here, this is sort of weak dollar plays, and you can see small cap stocks doing well. It's a lot of energy. That's, energy and financials are a pretty big weight in the small cap indexes. And so that's sort of fueling that with higher crude oil prices, and emerging markets obviously tied to commodities as well. What underperformed? Bonds were the weakest performer over the last week, down 4%. Here we have gold in the golden color, down 2.8%. Flat for the week was the US dollar ETF, the UUP. And then just pretty much in line with stocks, but just a tick below was the NASDAQ 100, down 1.7%. So overall, stocks up about 2%. Couple things outperforming, and it's things related to energy, emerging markets, and then obviously cryptocurrencies really driving out of all those assets much, much higher. Let's continue our journey by focusing on the Mindful Investor Live chart list. This is where I like to spend as much time as we can on a Friday just to make sense of things and sort of go through a consistent process. If you've not seen this before and this is your first time watching the show, the way you can get to this is actually if you go to the StockCharts homepage, go to the articles tab, which is our sort of our homepage for all of our contributed material. Up here where it says all StockCharts blogs, you can go to my page, which is called the Mindful Investor, and click on live chart list. It'll get you to this page that we're looking at right here. And it basically is a curated list of charts that I maintain pretty regularly and walks through my sort of basic macro process for understanding what's working and what is not. We start with the S&P market trend. This is a weekly chart looking at weekly data going back 5 years, and we're looking at the S&P versus some exponential moving averages. The long-term model turned positive here in June of last year and has remained extremely positive since, really speaking to the resiliency of the uptrend off of the March lows. The medium-term trend sort of gave a head fake here in October, turned more positive the first week in November and has remained positive as well. And that just speaks to the trend accelerating there. It originally turned bullish in early May of last year, which is about 2 months, month and a half after the bottom, then remained positive. The short-term model for me, I usually use the daily chart as a short-term gauge, but just as a holding point for that, I keep I look at the S&P versus its 5-week exponential moving average here in green. And so whether or not we're above or below that tells me the short-term trend. Just a quick estimation of that. It actually was below the 5-week exponential moving average. You see the low is down here. It actually went below that, and that was on Tuesday, as I think things were getting heated in the market. sort of wiggled around a good amount and sold off a bit into Wednesday. It got below, but closing the week to new highs, new all-time highs for the S&P again. And that means long-term, medium-term, short-term, the trend is positive, and that's about right. The daily chart of the S&P continuing to go higher. I always tell people, when a market's going to all-time highs, I tend to assume that that's going to continue. The path of least resistance tends to go with the breakout until proven otherwise. And so I think what you look for are things like bearish divergences, signs of exhaustion, signs of extreme sentiment and breadth that would indicate some sort of internal weakness or an exhaustion of buyers. But other than that, I tend to assume that trends are going to continue higher. Earlier on in my career, I was much more of a contrarian. I spent a lot more time with hedge funds. And so I was thinking a lot about more swing trading types of ideas. And when things get really heated, I would immediately look for a reversal lower, and time working with, a lot of time working with, money managers and long-term investors reminded me of the value of just sticking with trends that are working. And so I adapted a great deal to that idea of trend following. That really informs a lot of the comments that I make for you on the show now, is based on that experience. So when things are going to new highs, I'm all for projecting where things might go. I'm all for identifying a level at which it might be interesting to see if we reverse. But again, I tend to assume a trend is going to continue until proven otherwise. It is worth noting that at the close, as the S&P closed pretty much toward the at or near the highs of the day, the RSI on the daily chart is above 70. So the S&P is once again overbought for the first time since September. If you look back here, in all last two times, the S&P has been overbought over the last last 6 months or so, really after the March low was here. And it first became overbought the third, fourth week in August, which meant we went up another week and accelerated up before we topped out. In June of last year, we became overbought, and it was a couple days later that we gapped down, and it really didn't get much further than that, but certainly was a couple weeks of backing and filling before we resumed the uptrend. It really took about 6 weeks, 7 weeks before we eventually broke to new highs again. So I don't know if that's what's going to happen, but I do know when something becomes overbought, it immediately gets into my list of let's see what happens and look for signals of reversing, look for signals of mean reversion. I think that's where we're at right now with the S&P. One of the warning signs we talked about, and I know on the last show, I think earlier this week, we sort of touched on some of these, but the breadth has been a little less confirming up until the last couple of days. Last week, we had the S&P going higher, which is what we see here. But then if you look at this first line in green, that's the common stock only advanced decline line. So it's looking at the entire New York Stock Exchange, only the common stocks, not things like closed-end funds and other things. And it's looking at how they're confirming it. And basically, the cumulative advanced decline lines had not been breaking out. So there's a bit of a divergence. It wasn't as much of a huge divergence. I would call it more of like a non-confirmation, where the market's going higher, but the breadth line is not confirming that. That's actually been invalidated. That's been negated because these advanced decline lines have now all across the board broken to new highs. So confirming new highs in stocks. So the breadth, which had been a little questionable, a little less bullish, I think across the board, you could describe it as very bullish here. Another way the breadth has been pretty constructive is the new highs. So in the last couple of days, it's not updated for today yet, but I would anticipate a similar reading. But yesterday, the day before, you had about 20 to 22% of the S&P members making new 52-week highs, which is very, very healthy. That's actually much higher than what we've had through much of this run. If you look back, though, the last couple times we've had a spike like this, it's been before a bit of a pause, right? You had here in September before we came off a little bit. You had that on the spike higher in November. We really didn't get much lower for a couple weeks, but it sort of was a breathing, just a couple breaths before we continued higher. But overall, really just speaks to the overall strength, speaks to broad participation and a lot of stocks making new highs, which is a sign of a healthy market, not an unhealthy market. We've talked about the percent of stocks above the 200-day, over 90%, which is extremely high. If you look back and know your market history, it's pretty rare that many stocks are above their 200-day moving average. And it's been that way since really late November. That's when he broke above 90%. For the most part, it's remained above there unabated. So it really speaks to the broad advance. I've thought about that as a contrarian signal of sorts, thinking that the market had become overextended, but the market is proving otherwise. The market is telling you an uptrend is in place until indications go away from that, and overall it's remained positive. Where we have seen a bit of an alleviation of the euphoric readings have been with sentiment. So the AAII survey came out yesterday. We didn't mention it on the show, but bullish reading down a couple points to 42%, bears increasing down to 33.5%. So the spread between these two is actually narrowing. It's the narrowest it's been since early November, and you've seen a steady decline over the last couple months in the bullish reading. So still pretty high, over 40% on, is much above the average reading on something like this, but it's not the extreme euphoric reading we had in early November, which was similar to the extreme bullish reading we had at the end of 2017, which concerns me a bit here. And if you're thinking about what a top could look like, you had the big spike in bullish readings, almost 60%, and then we've steadily declined. And that's kind of what you had going into the January 2018 high before a bit of a pullback. And again, it wasn't the end of the world, but it certainly was ended up being a meaningful top for a little while. So it's something certainly to pay attention to. Let's go through some of the ratios here, a couple if we can get to them. Consumer offense versus defense, consumer discretionary versus consumer staples on a cap-weighted basis and on an equal-weighted basis, both of those confirming highs, suggesting institutions are really all in and riding equities higher. Semiconductors continuing to push higher. I could see that being a bit of a safe haven. If the market, if this group tends to do very well and hold up, I would think if the market starts to struggle, I could see technology as a whole doing well and semiconductors doing well as a bit of a flight to safety, but we're not really seeing it yet here. And then finally, I just want to finish off. I know we're about out of time here, but one more I wanted to hit was this one, right? So we've continued to see a weaker dollar. We're continuing to see US stocks underperform. We've been talking about this for a while. So I hope you have been focusing on some opportunities outside the US. Make sure you diversify, because as we're going to see in a bit, things like China are actually working out very well, continuing to break to new highs. So I hope you're not missing those opportunities outside of some of the stocks here in the US. We need to take a quick commercial break. Back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's such a pleasure to have you join us on the show, and we very much appreciate your questions. We've gotten such great feedback from you over time. We've been running the show now for over a year and a half almost, to be honest with you, and would love to hear feedback on what we can do to make the show better, what sort of guests we can bring on, if there are ones that you'd like to see more of or less of, or people we haven't had on that we could consider. I'd love to hear from you. Or just normal questions that come up as you are analyzing your charts, questions on particular technical indicators, on market history, on market dynamics, on investor psychology, whatever it is, we are here to help point you in the right direction. Shoot us an email at thefinalbar@stockcharts.com with your questions. Also on Twitter at FinalBarSCTV. You can just tag us in a comment, or on our YouTube channel, put a comment right below the video you're watching, and we'd love to answer one of your questions in our next mailbag segment, which should be Tuesday of next week. Having said that, let's open the Final Bar mailbag and answer some of your questions that we've received recently. Question number one. Hello, Dave. I like your show and watch every day. We certainly appreciate that. I need help to build a scan. My requirements are on balance volume equals all-time high, price less than 52-week below. I'm not sure what that means exactly. I'm guessing below it's 52-week high. So on balance volume is breaking out, but price is not. I'm guessing that's what you're saying. I'm having a hard time scanning on OBV at all-time high. So I have not run that particular scan on the scanning engine. I brought this up just before to show you, try to point you in the right direction. I'll dig in a little bit more to this, and if it's something I can come up with a nice polished scan, maybe I can share it with all of you next week. But there are a couple different ways you can try and screen on volume breakouts, and on-balance volume is a great way to do it. When you think about volume, right, there are a couple things you can do. You can look for volume spikes, so the volume above some sort of average daily volume, for example, or on balance volume, which is basically taking a running total of the volume and flagging it as a positive close or a negative close, and then stringing it together, similar to looking at a cumulative advanced decline line. And on balance volume was created by Joe Granville years ago, and it's a great way of sort of making sense of volume trends over time. There are others, to be honest, like Chicken Money Flow comes to mind that, you take that even a step further, that try to quantify volume over time. So I'd encourage you to explore some of those different options. But in general, the way our scanning engine works, there are a couple different commands you can do. Number one, in the drop downs at the bottom, you'll see technical indicators. That's where you can bring in on-balance volume and the on-balance volume signal line, things like that, and put them into your scans. The other thing you want to do, use commands like this. This is a different screen, but should point you in the right direction. This is saying I want the daily close greater than yesterday's daily max, looking at the last 65 days and looking at daily closing data. If you change that to refer more to the on-balance volume or whatever technical indicator, RSI or something like that, that's the way you can do it. You can even string these together. So you can say daily close greater than yesterday's close greater than 2 days ago close, 2 days ago greater than 3 days ago. You can actually incorporate a lot of commands in there to make sense of it. But by doing, referring to a particular data point and also using this max command, which will have a string of bars, a string of days, and the thing you're looking at, you can actually do it. If you didn't follow what I just showed, what I would say is at the bottom, we have this thing called scan examples, which have a bunch of pre-designed scans, some that have been contributed by StockCharts users, some that we've designed, some common things like, for example, our predefined scans. We show you what scanning, what scans we actually use to fuel those lists every day. So I'd encourage you to experiment with that. I'll spend some time with that as well. And if I can come up with a good way to do it, I would show you that. But Bill Shelby, who's sort of our scan guru, has always told me to look at those sorts of things if you're looking for changes. So in particular, you mentioned all-time high. We don't have an all-time high command, but I think if you use that and say above a max with a large time period, I think you can get pretty close to exactly what you're looking for. Thanks for that question, by the way. Question number 2, let's get to, is there a way that we can use StockCharts to isolate it's scanning day here in the mailbag, which is fine. Can we use StockCharts to isolate stocks that would be considered value or cyclical style factors with interest rates likely increasing in 21? It seems like it might make sense to focus more on that type as opposed to growth. I really love the nature of your question because I think you've hit on absolutely a key market theme. When you look at small caps that have done well, if you look at growth versus value, just the relative strength on things like energy and financials and industrials, you're certainly seeing more of the value trade working in a way that it hasn't in the longest time. And I think a lot of people have ridden the growth trade very, very well. And don't get me wrong, some growth stocks are continuing to do very, very nicely. However, I think you're also seeing things in something like regional banks, things like energy stocks that are doing better than you may have expected 3 months ago. So I think you're right to focus in on that. So what are some of the things that you could do? I would encourage you to explore some of the scans we have down here at the bottom. And I would say if you're looking for value-oriented places, here's what I would do. Number one, I would focus on industries that are more in line with value-oriented places. I would focus on the sector. So while it would be great to have some really deep fundamental value scans designed for you, we don't have a ton in our scan engine just yet. But I would say if you focus on some of the sectors and groups that you know are more value-oriented, and I think you mentioned some in your question, but also things like financials, things that would do well in a rising rate environment, things that would do well if we're looking more for sort of the traditional income-oriented blue chip types of names, and also down the cap tier, the small cap names. I think you're going to do well. So I'd focus by sector, by group, and find some of those that are going to do well. It's actually a very timely question as well, because I was just talking with as a management team, we're sort of laying out our plans for the year, and one of the things we spent a lot of time talking about today was the scanning engine and how we would redesign it. So I think we're going to be hopefully spending some time through the course of 2021 really improving this. And related to that, Grayson Rose and I were talking about our fundamental data, and Chip Anderson as well, our fundamental data feeds. We have an increasing amount of fundamental data looking at earnings releases, looking at valuation measures, and our plans are to actually expand upon that in a great deal. So I think the way that you're able to scan on that data and the way you're able to report, right, create reports, dynamic reports to help you make sense of how things lay out related to those valuations, I think you're going to find more and more coming from StockCharts over time. So that's how I would do it. I would focus at this point really on the sectors and groups that are pretty well in line with that, and then make sure when you use things like the symbol summary page, you'll see things like valuation measures that hopefully help you make sense of it. The last one, when there's a lot of sector rotation and flip-flopping going on, how do you rule in sector rotation versus the impact of individual equities that throw their weight around the sectors, indexes, and ETFs, which then begs the question, focus on individual consistent equities and ETFs more versus making sector rotation a primary priority? And I really, really love that question. I tried to address it, I think, briefly before the holidays. I can't remember if I really got into it, but I want to spend just a minute or two on that because I really like what you're asking about. You know, I'm often asked with coaching clients of mine about designing momentum models, designing models to help them make sense of a list of things. How can I think about asset allocation or sector rotation or stock picking using momentum, using price momentum or technical inputs, right? Essentially, which is, you know, essentially leaning into what's working and leaning away from what isn't working. And there are a number of ways to try to do that. You know, the way that we've in general tried to create that is by using the scooter rankings, which is a StockCharts technical ranking based on their trend characteristics. And if you look at the scooter reports on your dashboard, you'll see we have these different buckets based on region, based on the type of asset. So large, mid, small, each have their own percentile rankings. US ETFs have their own, industries have their own. One of the lists that I look at all the time is a list of ETFs that I created years ago and just sort them based on their scooter ranking. And what you'll see right now, it's things like clean energy, it's things like e-commerce, solar stocks. These are the one, you know, TAN I think is probably the number one. I could actually bring up the report. Yeah, TAN, ICLN is the clean energy ETF. These are all the ones that are appearing at the top, and you can sort them and see what's working and what isn't across a whole bucket of ETFs. You can do that with anything. So there are two ways that I see people try to do this. You know, option number one is throw everything into one big pile. If you look at a bunch of stocks, a bunch of ETFs, a bunch of asset classes, sectors, styles, and just put them in a huge pile and in general lean into the strongest trends. Overall, I would argue that's not a bad approach. The challenge that faces for a lot of people is you all of a sudden are allocating into a very narrow field potentially. So right now, everything at the top of the list has a similar feel. It's a lot of clean energy. It's a lot of solar. It's a lot of, you know, biotechs at time will all pile to the top of the list because there's so many in there. So you really have to be careful about what ETFs or what choices, what your universe is, and define that universe very, very well. When you're talking about stocks versus ETFs versus sectors, I would say, you know, we love to oversimplify. We love to say financials are working and consumer staples are not. Small cap's working and large cap isn't. Small cap growth is working, large cap value is not. And I would tell you, remember, there's a lot of overlap in everything that I just said, right? So when I see the small cap index doing very well or doing very poorly, a lot of times that's just a sector thing, right? So there's a ton of financials and energy in small caps. So if financials and energy are doing poorly, small caps are going to do poorly. And it doesn't mean that smaller companies aren't working. That just means it's a sector theme that's in there. So I would say, you know, you really have to do your due diligence, especially if you're looking at different levels, to make sure you're clear on what exposure you're getting and particularly what individual equity exposure you're getting as well. I'm getting in my ear that I need to move on, and I'm going to do so. Thanks for those questions from our front of our mailbag. Let's wrap this show with a 3 and 3 charts, 3 minutes. Here we go. Chart number one is healthcare. We didn't get to talk too much about this on Monday's show when we talk about sector rotation. I'll make a note to revisit this because it's worth noting the XLV making a new all-time high yet again, making a new swing high here in a nice uptrend. This isn't the only sector to do that. Technology at or near new highs, consumer discretionary. Healthcare is actually kind of an impressive one, and it's a sector that a lot of people have forgotten because on a relative basis, it's been such an underperformer for so long, but it's in a good uptrend. It's making higher highs, higher lows. I like the trend line using the lows, which has been tested a couple times here. I think you have a really good setup for potential for further highs here and a good risk definition if it does pull back. Chart number two is the solar ETF. Some of the best names in our scooter rankings right now are all in the clean energy space, things like Plug Power, which is the best mid-cap name, ENPH, which is the top large-cap scooter rank stock, and this ETF, the TAN ETF, which is a solar ETF, making new highs again this week. A bearish engulfing pattern going into the close, so worth noting as it's extremely overbought. Could be a bit of a pullback going into the beginning of next week, but overall, the trend remains fairly robust. Finally, China making a new 52-week high, the MCHI. Different Chinese ETFs have some different price characteristics based on how they're weighted and what exposure they have, but it's worth noting the MCHI making a new high again this week. Folks, that is our show for today, and that's a wrap for this week on the final bar. I want to thank all my guests this week, which have been just fantastic. Look forward to some great conversations next week. And Monday's show, where we hit the market from three directions: top-down macro, sector rotation, and bottom-up stock picking. For StockCharts.com in Redmond, Washington. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.